go into a recession first before we get a real bull run in crypto? Well, that's the question that I want to explore and try to give you the best answer I can here today about what happens before that money printer goes off and before we all get really, really rich. So let's get into it. And all you bears out there, you're not going to like my show. So watch yourself here because there should be a lot of trigger warnings for you guys since y'all are just like way too sensitive to get on a live stream with me and hash these ideas out. Shut the FUD up. Macro Monday starts right now. So welcome to today's program. Today, I got something that I want to break down for you all. So I'm going to put this up right here. Do we get a recession before the money printer goes off? I want to fill this out here for us today. We'll just do like a simple tally on both sides, yes and no. Just taking a look at what's the data say. As far as, is the U.S. economy strong? Is it going to stay strong? Or is it weak? Is it getting weaker? Is it going to stay weak? What's going to happen? That's what I want to explore today. But before we get into that here, let's take a look at the stuff that I usually always look at on every stream, what I think are the most important metrics. Let's have a peek here. How about we start with coin market cap? We get a slight pop today just now, because apparently Trump just came out and said, hey, the negotiations with China about trade policy are going pretty well. I mean, he's said this many, many times here, but apparently everybody today is just like, oh, well, let's take it seriously. And so they did. So, yes, we get a slight pop right here, back up to 115,000 on Bitcoin and 4,500 on Ethereum. Still, everything has been higher. You get a slight drawdown, like a retrace, or think of it as the receding water before the big wave comes in. Because like we look at a lot of these coins, like Hyperliquid, that should be at least $55. Kronos, that should be at least 30 cents. I mean, that hasn't even priced in the fact that the Trump organization is going to buy like $6 billion worth of it. Let me take a look a little bit further down. Nothing's really having kind of like a real blowout day. Everything is like pretty on point here. The main thing that's been very impressive, though, in this past few days is EHEX. Yeah, EHEX doing pretty good. And I was always told that, hey, EHEX is dead. It's not going to do very well. It's supposed to be bad. We should all just totally divest from it and kill it. But even with all of the hate from its own community being flung at it, it's hanging in there and doing pretty well. Some people are speculating, well, it's because like BankX is getting out of it. They only got about 20 million EHEX left that they can sell, so that's about $60,000 worth. And then when it comes to who's left in it, there aren't that many other people left in it. There may are whales left in it that they think would be working against the price. And I don't want to say for sure that there's nobody left to jeet out or anything, because there's always going to be jeets. But this is incredible considering like all of the hate that it's gotten for the past couple of months here. Because I heard a lot of hate from it even in our own spaces. So I'm impressed with that. Hopefully that continues, because, man, I would love to rub it in the face of some haters outside of our community, because you see, that's the chart that they always point to whenever they talk about HEX. They want to point to the weak one there. They say, oh, it's down 99%. It's down 99%. Well, when I look at this chart here, it says to me that if we're looking at the all-time, it is up 1,100%. Yeah, it's a little debatable because, like, the first price that it records is December 17th, but we know that this coin actually launched on December 2nd, 2019. So it doesn't really have like the first date here on Coin Market Cap, but it doesn't matter because nobody really got that price. In fact, everybody that got in at the very beginning is in profit because the coin was given away for free. So if we want to go for like what the original price was zero because you got the coin for free if you held Bitcoin. So technically, this all-time percentage should be a lot higher. But that's irrelevant right now because what everybody cares about is, well, what is it doing? What is it doing for us lately? Is it going to go past the previous cycle high? I tend to think so. So we're going to see how this all plays out. But I'm going to be as honest with everybody as I can. We've got a long time ahead of us between right now and when we see the next cycle high for just about every coin out there. Let's look at the other coins that we care about the most. Still pretty flat here in the RH ecosystem, and it's going to stay pretty flat. I mean, it's nice to see that Hex on Pulse Chain went back above 1 penny because it did fall below it. But still, we're going to be pretty flat, at least for the rest of today and for the rest of tomorrow and a little bit of Wednesday. I mean, we might get a good, nice pop Wednesday night after Jerome Powell's press conference after the rate cut. But here's something that really is important to focus on here, guys, is that what matters more with the rates and the Federal Reserve, what matters more is not whether they cut the rates or whether they keep them the same. The thing that's more important is, what is Jerome Powell's tone when he comes and does the press conference? Is he hawkish or is he bearish? Because that is much more important than, do they cut the rates and by how much do they cut the rates? Because we saw back in December of 2024, he cut the rates. He gave us a rate reduction, but then he got hawkish and talked a whole bunch of nasty trash during his press conference. What I mean by nasty trash is he's going there going, we think that we're going to need to pause some rate cuts in the near future. We're going to have to adjust our dot plot because we just don't know how all these tariffs are going to play out. Yeah, that's how he is there. His tone is more important as far as the direction of the markets in reaction to what he does. So, yeah, we get our rate cuts coming up in about 2 days, but don't place all the emphasis on the action that they take because their tone that they take is just as important. The traditional markets here in TradFi did pretty well. S&P's at a new high, I think at it's above 6,600, so that's impressive. And NASDAQ above 22,000, that's impressive as well. Didn't really see a lot of stories on there to care about. This is something I want to talk a little bit about here today. The DXY, right now it's at 97.36, which is still high. Still high. It's got a long way to go to start getting to where we need it to be for us to have our bull run. Still got a long way to go there. But if y'all know Gareth Soloway, he said something very interesting in an interview that he had recently on one of those TradFi programs. So if you listen to like the TradFi streams like I do, and you saw Gareth Soloway on, I think it was called Real Story with Michelle McCory, he said something very interesting here about DXY we're going to talk about today. And it's something that is very bearish for the U.S. economy, but very good, very bullish for crypto. It's interesting how those two things kind of oppose each other. Let's have a look here at interest rates. Here we got some good news. The 10-year is back down to 4.03. Man, it is so close to falling below 4%. Now, I don't know if it falls below 4% that it capitulates and goes further down. I don't know that it does that because when we look at these basis points on the 10-year Treasury, that is actually trillions of dollars being dealt with when you start moving by about 5 basis points. And it takes a lot to make it move like that. But check this out. The 90-day Treasury, the 90-day T-bill, is below 4%. This was like the last holdout in T-bill land that was above 4%. Now it's down below 4%. And what would be like a very positive reassurance for me is to see all of these treasuries below 4%. That would be very positively reassuring for me. As far as the rest of the market going on here, or as far as like the prediction market for the rate cut, it's going to be 25 beeps that they cut by. And very high likelihood that it gets cut. Very high likelihood. I mean, it would be such a rug pull for J. Powell to come out and not announce the rate reduction and say, yeah, we're going to pause and be data dependent. That thing he always says. But we know that we'll get 25 beeps. Some people think the market is already pricing this in, and that's why it had a nice pop today. Maybe the stock market is pricing it in, but guys, the crypto market is not pricing this in yet. No, the crypto market has not priced this in, despite what they say here. Because you may have seen on Twitter this thing going around that shows altcoins have never been anywhere near as oversold as they are now. Not even during the pandemic, not even during like some previous disasters like the 2018 bear market. They've never been more oversold than they are now. And what I want to know, though, is what type of crack are they smoking over at CoinMarketCap to say, well, 71 is our alt season index, and that's a rating out of 100, so it was a 71% chance that we're in alt season right now. The methodology that they use for it is faulty here because, you see, it goes back the last 90 days to see how many coins have outperformed Bitcoin. That's such a crummy metric, such a crummy way to do it. And it's only coins in the top 100 as well. And this is such a useless way or such a faulty way to be measuring this here because, you know, for one, this is a very small section of the overall market. Very small section of the overall market. And then when you look at the 90-day performance, for me to see something like, 80% over 90 days for Link, that's not impressive to me because I've seen Link do much better in a shorter amount of time. So this is just a faulty way to judge, are we in alt season? I wouldn't pay much attention to that. The market cycle top indicators, all of them are still negative or not triggered. Not been set off here yet. So again, everybody going, oh, it's all over. Well, why hasn't a single one of these triggers been hit off yet? At least 10 of them should have been hit off if the bull market even started. This is why I say bull market hasn't begun. One, the money printer didn't get turned on. And then two, the top indicators, not a single one of them has been reached. Little housekeeping for you all. If you want a copy of this book that I wrote called Your Parents Were Wrong, Debunking and Replacing Outdated Advice, you can get a copy of this book 100% free, costing you absolutely nothing. You won't ever have to pay a cent. All you got to do is come on over here to my Substack. That's reinventideal.substack.com. I repeat, reinventideal.substack.com. I will be releasing a new column on there either tonight or tomorrow. And what you do is head on over to where it says free gift. And you just scroll down here and you click subscribe. It doesn't cost you anything at all to subscribe to my Substack. And once you subscribe, you get an email that gives you this book for free. So that is a little gift that I have for all you guys on there. So let's get into like the real meat of today here. And Sigma's Club, you ask, did we already talk about a recession? Like, yes and no. Not kind of like in the way that I want to. Like what I had said last week, the last stream that I did, is that the process for how that money printer gets turned on can happen in a couple of ways. I mean, what we could see is first, we have a recession, and that triggers them to turn on the money printer. Sorry, I gotta adjust this light because it's bothering me. All right. So what I was saying is like, first, what could happen is the 10-year treasury goes down below 4%. A whole bunch of stimulus spending occurs. And when the 10-year treasury goes down, that's basically telling everybody, hey, growth and inflation expectations are very low. And if growth expectations are low, that means we're probably headed towards a recession. They can issue a lot more treasury bonds, a lot more debt, just because like the debt is cheaper now, and they're going to have to like try to stimulate the economy. But then we go right back to where we started, where the treasury yields go up higher because we're in a recession now, and we're spending more money, the federal government, and nobody has the money to buy these bonds. That's when the Fed has to step in to buy up some of those treasury bonds to bring the yields on them down. They got to do what they call curve control. I think that we could skip a few steps in that whole process, because that sounds like it could be a very long process to get the money printer turned on. What I think could happen is like something completely unexpected happens that dumps us into a recession. I say unexpected lightly because it's going to be like one of those things where we should have seen it all along, kind of like 2008, where they're like, oh, yeah, nobody saw it coming. Well, there were some people that predicted it and knew it was coming. And then the Fed is acting, but the Fed is acting late, and the rate cuts that they're looking to do are just not effective enough to bring the 10-year treasury down. So what they got to do is they got to take a step further, turn on the money printer, and do quantitative easing to take those treasuries off the market, put it on the Fed's balance sheet, and taking those treasuries off the market will then reduce the yield on it. And because it's no longer worthwhile for anyone, it's no longer like that attractive to buy a 10-year treasury. Well, that's trillions of dollars now that needs a new home, needs a new place to invest. Trillions of dollars are going to be looking for new places to invest, and they're going to have to look at risk on assets like stocks and crypto. You guys might remember here, like the stock market and crypto are kind of merging together in the sense that they're going to be a lot more correlated than usual because of treasury companies, because of ETFs. We got a lot of ETFs that I think they are going to be approved either in October, probably the very latest be November. You'll see those start trading. And even if like boomer money doesn't end up in those ETFs, still we can get a lot of we can get a lot of like pairing and correlation of those ETFs when portfolio managers in TradFi start using them for their own purposes, even if they just allocate a little bit. If they just do a little bit. Thrilly, you got a question there. Let's see. Imagine we get a 50 basis point cut on Wednesday. What kind of grenade does this lob into the market? I don't think we get that cut. I mean, if we did at this point right here, yeah, that'd be a grenade because nobody would be expecting it, and everybody would be going, oh my gosh, what's the Fed know that we don't? Spoiler alert, they don't know anything more than you do. See, these people, they don't have like access to real exclusive knowledge like everybody thinks they do. It's just like, back when I worked in TradFi, and I was just like a very humble stockbroker for like my first job there. Everybody seriously thought that us stockbrokers had like some insider knowledge, and they asked us, oh, what do you think I should buy? What stock do you think is a good one? And I'm just like, bro, man, we don't know anything more than what you know because we're not allowed to know. All right? There are heavy laws and regulations in place keeping walls of separation between us and the analysts. So relying on me to tell you some golden inside secret knowledge of what's a great thing to buy, it's not a realistic thing here. And in the same way, like the Fed doesn't really know much more than everybody else knows because we all got access to the same data. The main problem with the Fed, though, is that they're ignoring very good data in favor of real crappy data. They're looking at some real crappy ones, like as far as the data on the jobs numbers. They're relying on the unemployment figure, which is probably one of the worst ways to track the jobs market. And like even some of the other ones, like labor force participation, that's not really all that great either. Because when you look at how they collect that data, the Bureau of Labor Statistics, the way that they collect it is They send out surveys to these companies. There's nothing compelling these companies to fill these surveys out promptly, and nothing compelling them to fill it out accurately. It's just like, hey, can you please do this? Now, if you are hiring and your company's in a great spot, well, I think that, yeah, you're compelled to, in a sense of like, oh, yeah, I can do this because, we're in a great spot right here. I got the time to do this. I'll send it back to them and tell them, yeah, we're in a great spot here. We're hiring. Economy's great for us. Ain't no recession here. But if you are not hiring and if you are struggling, you really don't have time to be filling out no surveys now, do you? No, you don't. So a lot of negative information that is true, but it's not pleasant, and it's unpleasant truths that we need to hear, does not get reported. I mean, way back when I ran my laundromat, if I got a survey like that in like the first 6 months of running that business, those were the worst 6 months of my life because it was really hard opening up a new business in a area that was already pretty saturated with laundromats. It was an absolute struggle all the time. If I got a survey from the Bureau of Labor Statistics, you know what I would have done? I would have thrown it out. I ain't got the time for that. And that place was literally a 24-hour-a-day job. Didn't have time to be filling out surveys. Barely had time to fill out the forms I needed to fill out, like for taxes and permits and everything. All right. So we're going to keep a scoreboard here of what tells us, are we in a recession or is a recession coming first? Are we going to experience that before we have our bull run, before we have it really get started? Because I keep saying, yeah, the bull run has not yet started. I still stand by that. It has not started. I know some people are out there saying, oh, well, it's all over or it's almost over. And we kind of had a debate on RH Max's channel about that, but I guess Pedro was not that bearish on it. He didn't think that it was all over. He just thinks that it's going to end sooner, and that's fine. Yeah, I'll never say anything bad about him because he was bold and brave enough to get on a stream with me, which I have a ton of respect for. I got a ton of respect for Pedro in that because there are so many cowards on X that are happy to leave nasty comments under all of my posts saying, oh, you're stupid, Cairo. You think the bull run is still yet to come when it's already all over. And they have the courage, apparently, to leave a post, but not the courage to get on a stream with me and show me where I'm wrong. You see, I want to be wrong. I would love nothing more than to sell every one of my positions and go down to Puerto Rico and spend the rest of my life there, or spend at least the next year there. Get out of the capital gains tax. Might go to Uruguay actually for final expatriation. Hear good things about it, but none of them are willing to come on and debate me or set me straight. T-Bird, sent you a DM. I know you're out there and everything. If you're watching, do want to stream with you. We know you got a lot of stuff coming up here. You couldn't stream last week, but definitely still want to stream with you. And then this challenge goes out, as always, any bears out there who think that the bull market is already over or is close to over and think I'm just so incredibly wrong and you want to come on here and set me straight and you have the ability to show me where I'm wrong, you are welcome to come on here. I am happy to have you on. I'll even go on mute while you're speaking because I don't interrupt people, as you saw with my debate with Pedro. But if all you're going to do is just come on here and spew a bunch of crap long after I debunk it, I'm sorry, this ain't the place to do that.
Sometimes you just gotta shut the FUD up.
That's right, and that's what I'm going to tell you is that you're just going to need to shut the FUD up. All you people that are spreading all sorts of FUD, like the new FUD going on right now is, oh yeah, EHEX might have pumped, but it's only going to last for about 18 hours, and then everybody's just going to jeet right out of it. I'm watching it very closely. It seems to be holding its pump pretty well here, just kind of like how PHEX is holding the penny line pretty clear. And it's amazing that it's doing this with such unfavorable monetary policy. Do you see the guys that are saying that, they don't understand monetary policy and how it's such an unfavorable quantitative tightening environment that just kills risk on assets. They have no frame of reference or knowledge of how that is. I mean, that's the best thing. That's the best thing I could say about them. I mean, it's me giving them more credit than they frankly deserve. Because if they do know, well, then they're lying, and they're intentionally lying. I mean, it's one thing if you're just not investment literate. I can forgive that because I wasn't always investment literate my whole life. But when you are investment literate and you're running around saying, oh, yeah, all hope is lost right now, that's FUD. And you know how I feel about FUD? I feel that this song is what should be sung.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. And this current time is just one of those times you gotta shut the fuck up. I don't think you're a bad person, I just don't want to hear you talking anymore. You gotta shut up.
All right. So, any bears out there, and you think I'm just dead wrong, and you're ready to tell me how I'm dead wrong, I'm happy to have you on, and you can show me. So, today, though, we're going to get into the scoreboard. Are we in a recession, or is it not going to happen this time around? Or are we going to go into a bull run after a recession occurs? We're going to get into all of that here by looking at the data. But first, we got to pay some bills. I got to play an ad here for you guys.
Why does crypto suddenly explode into unbelievable bull runs, only to crash just as fast? It's not luck. It's not random. It's macroeconomics. In decrypting crypto, you'll uncover the hidden forces driving every major crypto rally, forces tied to the global debt machine, central bank liquidity, and repeating market cycles. This isn't another blockchain basics book. This is the blueprint Wall Street doesn't want you to read. The playbook that shows you why crypto moves when it does, and how to spot the next bull run before it starts. Don't miss the next cycle. Read Decrypting Crypto. Arm yourself with the knowledge to ride the wave before it leaves you behind. Decrypting Crypto by Cairo Code. Available now on Amazon and Audible.
All right, so there you go. There is my book. It's called Decrypting Crypto, and it explains to you and breaks it down in precise detail what causes the cycle, what causes the bull runs to occur, what causes all of this to go on. And when you read that book and you see me break down how it all happens, what are the dominoes that fall in line and everything, well, I think then there you will just kind of like know how to navigate these cycles inside out. I mean, you'd probably become such an expert at it, you'd be able to co-host the show here with me. But that is I think the best book to kind of help you be able to explain to your friends when they ask you, hey, like, why do these coins go up? Because that's going to be the question that keeps a lot of people skeptical if we can't answer it. If we can't answer why does the prices go up, what's causing it? I mean, that was what had me so skeptical at the very beginning, way back in 2017. I see RH Max is here. Hey there, Max. I see Tam Tam is here. Hello to my number one cheerleader. You will catch both of us in the Twitter Spaces tomorrow night at 7 p.m. East Coast time. Now, let's get into the scoreboard here today for, where is it? Where's my, hang on. I'm trying to share the screen here and gotta share the right window. There we go. So this is going to be our scoreboard for, are we in a recession, or is one going to happen before the money printer gets turned on, before our bull run really begins? And yeah, if you need reassurance that all we need for the bull run to get started is the money printer getting turned on, and it doesn't necessarily even have to be the Fed balance sheet with quantitative easing. There's other forms of money printing that can occur, but the assurance that that's all that we need and that that's what really drives the crypto market, as my book, Decrypting Crypto, will show you, just take a look at the hex chart and look at all of the times that it went up it correlates perfectly with when they printed money. And I'm specifically talking about EHEX just because it was there, it existed back when when money printing was occurring. Because you see, Pulse Chain's Pulse Chain itself, and also Hex on Pulse Chain, has never existed in an easing environment. It's only existed in a quantitative tightening environment. So we don't know how amazing that Pulse Chain Hex could do. We don't know how good that could do yet, just because we've never seen it in an easing environment. My guess is that it will do very, very well. So, what's the data here say? Well, consumer spending is declining, and that is a leading indicator of an economic slowdown. So, I'm going to put one right here for yes, recession. The jobs numbers, we got labor market weakness, especially July. The jobs numbers were weaker than expected, significant downward revisions. New entrants, especially college graduates, they're facing higher unemployment rates, which, man, this is something like, this is why you want my book, Your Parents Were Wrong, because there's a whole chapter on it about college here, because like now we've gotten to a point where college is actually a financially detrimental decision to go to college. It actually hurts you financially more than it helps you. I mean, it's like financial cancer for you to go there. That's how bad that it's gotten, because you're taking on debt, or you're at the very least, like even if you got a scholarship, you're taking very productive years off of your life to get something that doesn't even get you a job. Or if it does, it doesn't even get you a living wage job. So it is actually a backward step for yourself financially. And some people will say, well, AI is reducing hiring. No, I don't think it's the AI reducing hiring. I mean, job openings are at post-pandemic lows. But I think that the issue is that many of these companies have interest expenses that are just too high. And the interest expense being too high, I mean, that's why they want the lower rates. And of course, there are reasons why these companies want lower rates, is because they want to take out loans to go buy back their own stock and pump the market to even more ridiculous heights. That's, of course, is a thing. But a lot of these companies use debt to take on employees because they don't want to use the cash that they got sitting in their treasury. They want that cash there because that gives investors comfort when they can show them a balance sheet that has a lot of cash on it. So, labor market weakness, I'm going to say that is another tally here for recession. Housing market, and specifically with the housing market, what we can look at is housing starts and permits. Those are down over 20% year over year. Now, with that housing starts and permits and everything, we're looking at building new houses, and it's not just a matter of is there enough supply to house people, but when you're building houses, that actually has additional benefits for the local economy that they're building those houses in. Because, first they got to set a foundation. There's workers that got to be put to work to do that. You got to bring in a plumber to connect it to the city main water lines. You got to bring in an electrician. You've got to bring in an HVAC technician. You're going to also have, when these houses go up, you're going to bring in painters, interior decorators, some lawn care, landscapers, and everything. And you got to buy parts regularly. I mean, when you're building a house here, even on a professional site, you're going to have guys from the construction crew go run to Home Depot at least 15,000 times during the construction of that house to pick up some spare parts. So it does a lot for the local economy that it's in. Well, we also got not just the permits and starts down, but affordability is at historic lows. Nobody can afford a home. New home prices are actually significantly cheaper, though, than existing home prices, which is signaling a potential bear market in housing, because you see boomers and older generations, right now they dominate the home purchases. That raises concern about future demand, because boomers aren't going to live forever. They're going to die at some point. And the boomers, they're actually the ones that kind of control all the wealth right now. I remember last week when I said that 50% of all consumer purchases, or all consumer spending is done by the top 10% of earners, or we could say the top 10% of economic participants, a lot of that is boomers. You see, boomers got all the wealth just for the fact that they've lived the longest. There, you live longer, you have more money. Johnny Chaos is here. Hello, Johnny. We see you in the chat there. So let's also add another tally here because the housing market is bad. That could by itself cause not necessarily a recession all by itself, but it could cause a dramatic slowdown, I think. The Chicago National Activity Index shows a downtrend. That's also an indicator as well. Las Vegas, you probably heard a lot about Las Vegas, leading economic indicator that they're struggling. And you see, that's where a lot of people go for vacations. That's where a lot of like the rich go to just piss away a lot of money to have a good time. Vegas is looking more like a ghost town now. So I'm going to also give that a tally for yes, recession coming. Yeah, market dynamics and recession risks. We got no official recession that has occurred since 2009. 2009 was the bottom of the great financial crisis. But that's just because we've been in them, but we don't really call them recessions. I'll explain that in a second here. But we haven't been in an official, they actually admit we're in a recession since 2009. Mainly because of federal deficits, about $2 trillion annually, and that has been sustaining economic activity. This is why they didn't do the Doge cuts. So they did the Doge cuts, the deficit would be a little bit smaller, and when you do away with the federal deficit, that will hurt GDP, and no president, no politician wants to preside over negative GDP. If you close the deficit, we would have negative GDP. I'm not saying that that's good. Not saying I agree with that. Not saying I want that, or that I'm not using that as an excuse to justify deficit spending. But that's why we have it, is because without it, GDP gets hurt. So, yeah, it sucks. And it's just going to have to be a fact of life going forward. We did have a short recession in 2020, and then we had another one in 2022. They just refused to call it one. Because we had 2 quarters of negative growth. 2 quarters of negative GDP is a recession. They refuse to call it one. But because of that, they say, well, we're long overdue for a recession. I'm going to use this as no, that's not really a recession. Or that's not a reason that we're going to have one, is what I'm going to say. It's not a reason we're going to have a recession, that just because we haven't had one since 2009. Because we did have one in 2020. It was really short, and we had one in 2022. They just refused to call it one. All right. Now, markets are pretty complacent. Stocks, gold, Bitcoin are all at new all-time highs. And the lack of recession expectation could lead to a severe market reaction if a downturn occurs. But here's the other thing. While Bitcoin is at an all-time high, most of the altcoins have never been as oversold as they are right now. You've seen this, you've probably seen this a bunch of times on Twitter, because it's true. Even during the pandemic, even during FTX, the altcoins have not been as oversold as they are right now. And that's also true for a lot of stocks as well. There's a lot of stocks out there that haven't been as oversold as they are right now, because you see what's propping up the stock market is just like the top 10 stocks. I mean, the top 50 stocks account for 60% of the entire stock market. So I'm going to use this as the no, tally for the no here, that there's not going to be a recession, just because stocks are a leading indicator of what the economy may do. And since most of the stocks haven't experienced new highs like the Magnificent Seven have, or like the top 10 or top 50 have, since most of them out there haven't experienced that, we can't really say that the overall market is totally overvalued. I mean, just look at how small the Russell 2000 is compared to the S&P 500. S&P 500 is the 500 largest companies. Russell 2000 is the 2000 small to mid-cap companies. There's just no comparison between the two. Like Russell 2000 is totally dwarfed by S&P 500. So clearly 2000 stocks over here are super undervalued compared to the big 500 that are overvalued. And really, it's only the top 50 that are overvalued. And the same goes for crypto. More than half of that $4 trillion market cap number that they keep talking about and say, oh, it's a new all-time high for the market cap. Which, yeah, that's true. It's a new all-time high for the market cap. But more than half of it is in Bitcoin. Because Bitcoin is $2.3 trillion. And then the next one down, like a half a trillion, is Ethereum. So practically $3 trillion is concentrated into the top two coins. One is at a new all-time high, Bitcoin. The other one, Ethereum, is not. It's barely even tapped a new high. So we can't say that the crypto market in general is overvalued. Most coins are down more than 60%, especially on page 1 of CoinMarketCap. I have been on that kick for multiple times. I've shown you guys multiple times. Yo, look at page 1 and how many coins are down more than 60% from the all-time high. Look at how many coins are down over 90% from the all-time high. That's something that they like to use to kick hex while it's down, but plenty of other coins are in the exact same spot. So I'm going to say that stocks and crypto do not indicate a recession's on the horizon. Federal Reserve is facing some conflicting forecasts, like the Atlanta Fed versus the St. Louis Fed. They have differing opinions, and that's adding uncertainty. There's also a debate going on here about what Lynn Alden calls fiscal dominance, if that's going to become a real concern. I would tend not to second-guess Lynn Alden, but there are also some very smart people that are second-guessing what Alden has said. So that's going to be an interesting debate here to see. If they have one. I mean, we're going to see it play out in real time, who's right. I'd love to see them do a debate on it, though, just so we could all learn a lot more from it. There could be yield curve control coming in. And bond markets, they're showing yields are going up, but also yields are going down with the weak economic data. You see, let me show my screen here for that. A lot of people think that yields have done nothing but go up so far this year. It's not quite the case. It's not quite the case here. Yields have not been going up all year long. Matter of fact, let me see if I can find the 10-year Treasury chart. Because I remember earlier this year, the 10-year Treasury was a lot higher. Yeah, I found one here. Hang on. Share the screen again. Where was it earlier in the year? Here it is. I mean, the short thing to say here is that the 10-year Treasury has actually gone down this year because towards the beginning of the year, this thing was at 4.8%. It almost hit 4.9, almost went to 5%, which we kind of do want that eventually, because that is probably going to force the Fed's hand to turn on the money printers. We want it to either go like really high or we want it to go really low. We don't really want it where it's at right now, which is roughly right at 4%. Well, Liberation Day, look what happened here. Went down to 3.99. It just kissed it and then came right back up. And that was because the growth and inflation expectations were low with all those tariffs that were coming down the pipeline. We kind of wanted to, we want it to either go higher than where it's at now or lower than where it's at right now. We don't want it to be where it's at right now. But even with the force of presidential authority saying, hey, I'm going to put some serious tariffs on all of these other countries here, even with all that, it couldn't really push it down much further than 3.99. And I think that it would have a really hard time getting pushed down further without an economic disaster. So I guess what I'm trying to say here with the treasuries, like, why am I bringing all this up here to say that, like, the treasury yields have been going down all year? What's the point of that? And the point of that is to say that that does not necessarily spell money printer on the near horizon with where they're at right now. So back to our scoreboard. Treasury yields indicate growth in inflation expectations. As they go down, well, in that case, that means a recession could be coming. They have come down, but they haven't come down by much. Not really even a full 1%. So I'm going to put this on the no part of the scoreboard, that those treasury yields don't indicate a recession coming. Matter of fact, if we got 4% growth in a year in GDP, that's incredible. We haven't had that since the 1950s. Yeah, what about some other indicators? Gold and silver. Well, gold has surged to a new all-time high and could be hitting 4,000 before the end of the month. And it's driven largely by the central banks buying it up as a reserve asset. That is a recession indicator. Why are they buying gold instead of treasuries? They're buying gold because that's the asset you buy when you think something bad is coming down the pipeline and you want real money. You want what they call God's money. Silver is also breaking above $40, and it's expected to outperform gold coming up throughout the rest of this year. And the gold miners, like the ETF GDX, is up, that's not the stock GDX is up 95%, and then the ETF GDXJ is also up significantly as well. That, I would say, is a recession indicator. That one denotes the possibility of recession. Now, other commodities like copper, uranium, platinum, energy, they're also highlighted with tight supply and rising demand, especially with the use of AI. See, AI is very energy intensive. As you haven't heard a lot of bitching about Bitcoin mining or proof of work mining in general. Yeah, you haven't heard a lot about that because right now AI has really stolen the show as far as being bad for the environment. Because whatever Bitcoin does, AI is much worse for the environment with the computing power that it uses. Now, industrial metals like platinum and copper, they're going to get put to a lot more use. And energy ETFs are going to get put to a lot more use and everything. So there's lots of demand for these guys. And because there's a lot of demand for the industrial metals, that would be a mark against that would be a mark of saying no recession. Because you only go after these industrial metals, you only buy a bunch of these when you think that they're going to be consumed. And if there's a lot of consumption with industrial metals, that would indicate there's a lot of economic activity coming ahead. How about liquidity and fiscal policy? Global liquidity growth has slowed. It's down from 11 to 15%. It's down to just 4%. Everybody keeps everybody keeps losing their minds on Twitter. They're going, oh, look at the M2 money supply. It's reached a new all-time high, which is true, it has. But the growth on it it's been pitiful. It's only been about 5%, really. And 4%. But you can say 5% on a good day. And here's the deal. In order to meet 2% inflation, the Fed's target of 2% inflation, GDP, or not GDP, sorry. In order to meet the Fed's 2% inflation, the M2 money supply needs to grow by 6%. Need to have 6% M2 money growth in order to just get the 2% inflation that the Fed wants. And there's a formula behind all of that. Maybe one of these days I'll go through it. But it's not the most exciting thing ever. So what I'm trying to say here is that the global liquidity growth has not been very expansive. What we are experiencing is still a tightening environment. This is the opposite of money printing. we still get a little bit of fiscal stimulus in the sense of like there's federal deficit spending, and that's keeping like new money being shot into the economy, kind of like epinephrine being shot into Jack Bauer on 24. You know, he was right about to die, and they shoot him up with epinephrine. That happened at least twice in the whole series of the TV show 24. It was a great show for a while there. Then it just got like way too repetitive as far as the storylines. Like what happened is like they'd uncover the villain and unmask him and then find out he was working for somebody else much bigger and then find out that villain was working for somebody else. It just got way too predictable. Man, those first couple of seasons were really good, though. But the Trump administration is pushing for growth, lower interest rates, and a weaker dollar, which will support the commodities. So because we have slower M2 growth, I'm going to put that over here on this side. That, like, yeah, right now, that denotes a recession. Because if you're not growing M2 money supply, that means, well, you're also probably not growing the real economy either. You're not growing the stuff that money can buy, the goods and services. Now, stablecoins are a focus because Treasury Secretary Scott Bessent wants to attract about $2.7 trillion to finance U.S. debt at lower rates and disrupt the $11 trillion euro-dollar market with Treasury bills. That one I'm going to put over here as not a recessionary indicator. If he gets his way with the stablecoins, that would save the United States from a recession. I think it's a high likelihood that something like that does happen. That their intent with the Genius Act and what they want to do with the stablecoins to use it to do a little curve control on the treasuries. I think if he gets his way with that, that's probably what really kicks us off into the bull market. And that also, by the way, counts as money printing. It's not like quantitative easing, but when you bring those euro dollars over here, when you repatriate the euro dollars and get them into U.S. banks have to buy treasuries, and they buy it with printed money. So I'm going to put that over there as no, not a recessionary indicator. How about the dollar strength and the yield curve? So the U.S. dollar is in a structural downtrend. It's got a 5-year support to break. Let's take a look here at that. See, it supports commodities and emerging markets. But where's that dollar index? Let me pull that up here. I'm going to look at like the 5-year trend on it. All right, don't have the 5-year, but let's go back to, okay, here we go. 2020. See, I can get us a 3-year trend. Good enough. So, yeah. I'm going to do the all-time again. It's like, yeah, where it's at right now is still higher than it's been at over the past 5 years. It's at 97.44. 5 years ago, the thing was at like 96.85. So it's got good support right here. It's got good support. Now, what's the significance of this right here? A strong dollar does not denote a recession. So back to our scoreboard. What's that say? I'm going to put that over here for not recession. All right. The yield curve is expected to steepen. That benefits specific investments like mortgage, real estate investment trusts. And when the yield curve steepens, you see what matters there is like we got to know, well, is it a bull steepener or a bear steepener? We'll get into that one of these days. We'll explain that. But when the yield curve steepens, that just means it goes back to normal. When the yield curve goes back to normal, that's not a recession. See, when it inverts, that is considered a recessionary indicator. I mean, by inverted yield curve is when the 2-year treasury or something shorter has a higher yield than the 10-year Treasury. And right now, we still got an inversion between the federal funds rate and the 10-year Treasury. We need those two to flip before we get a bull market. Next piece of data that we got here. U.S. economy shows signs of weakness despite stock market hitting record highs. Headline CPI is at 2.9%, and that indicates that it's persistent inflation. Bureau of Labor Statistics, where I covered this one, erased 911,000 jobs, rise in jobless claims. We do got unemployment numbers coming out Thursday, the day after the Fed's decision. I think that they'll probably hear what the numbers are before they make their decision. Here's a negative indicator, though. Insiders are selling their own stocks. We're talking Jeff Bezos, Mark Bainoff, and Mark Zuckerberg, Jensen Huang. They're selling their stocks. These are CEOs of their companies, and they're selling their stocks at an unprecedented pace because the insider sales are outweighing the insider buys. You see, when you're an insider, like, you're a control person, like you're an officer or a director in a company, or you're somebody that owns more than 10% of the shares, you have to disclose your intent to sell shares of your company's stock, just because your sales could cause a panic in the stock. Because everybody's thinking, well, if Elon Musk is selling his shares of Tesla, well, maybe he knows something bad is about to happen to Tesla. He obviously has information that we don't. So that is an indicator of recession. You see how tight this race is here, like how it can go either way? Yeah, it can go either way here so far, and it's kind of like this all the way down the line. Market exuberance, that's when stocks are like going haywire within a day here, having like these unbelievable returns. Like Oracle got a 40% pop, and that made Larry Ellison the richest man in the world now. He's richer than Elon Musk. For a big company like Oracle, big company, like a mega cap company, to get 40% in a day, that's incredible. That's exuberance. For QMM to get 2,700 in a day, that's unheard of for stocks. And I think how they did it was they just said that they were going to buy a little bit of crypto for their treasury. Another company, Octo, did the exact same thing, and they went up twice as much. And this looks a lot like the whole .com bubble. It looks a lot like it because back then they just put like the letter E in their name. It's like E this or I this, like iPhone. Maybe the iPhone worked out. Esurance was one of them for like the insurance companies. So because it's a lot like the .com bubble, I think I'm going to use this one here to say that, there's irrational exuberance in the stock market. Don't know if we got that going on in crypto right here because still the altcoins are super oversold. The S&P 500's price-to-sales ratio, the PE ratio, the Buffett indicator, which is total stock market value versus GDP, they're higher than they were during the .com era peaks. So that's indicating that, hey, there's overvaluation, and that overvaluation indicates that we probably are going to have recession. Basically, like all the good that's going to happen in stocks is coming to an end, is what this is thinking. Federal Reserve and rate cuts. Well, the market expects there to be 3 rate cuts this year, starting in 2 days. Gareth Soloway believes that these are already priced in, and he actually expects Jerome Powell to be hawkish in his press conference on Wednesday. I don't like that. But you see, Soloway, I wish I could stream with him right here because I'd like to hear him out on all of this. It's like he would be a formidable opponent as far as a bear goes. But he thinks that Jay Powell is going to be hawkish and emphasize that there's persistent inflation, and that could dampen expectations for there to be aggressive cuts in the future, and especially in 2026. And historically, Fed rate cuts often precede market bottoms, not recoveries, because they signal economic trouble. When you got slow cuts, like just 25 beeps in each meeting, that could exacerbate fears of recession because it's going to lower corporate profits and PE ratios. So for that one, I'm going to put on the scoreboard yes to recession if they are slowing down the rates of the cuts, because being slow to cut could cause recession on its own. And the reason why they raise these rates actually is to cause a recession, to slow down the economy. Not really cause a recession, but slow down the economy is what they're trying to cause. Stagflation, is that a thing right now? Slow growth and high inflation? Kind of got stagflation going right on. It's complicating Fed policy. We got inaccurate job data. We got jobs numbers that are, the way that they collect it, or explained that earlier, the way that they collect the job data is just not a good way to do it. The government doesn't enforce timely survey responses. So that, we go into stagflation, could just have a recession as a result of it. So I'm going to put another recession indicator over there. Bitcoin. Now, Gareth Soloway actually predicts that come Q1 next year, Bitcoin will face a severe correction going all the way down to $75,000. And he really thinks that it's all going to be over this year. He actually thinks it's already over. He's one of those guys that says it's all over. And I'd love to get in a debate with him or get on a stream with him. I'm way too small potatoes for him to even think about. But yeah, he thinks that it's all over. And he also thinks that there'll be a 20 to 30% stock market correction. Bitcoin's going to correlate with those equities. He thinks, well, maybe we could have a slight rise as they'll be supported by institutional holders. So, not sure how much weight I give that, though, because you see, they say that all the time. And for Bitcoin to really be at its top, what has to happen is you have to have nobody saying stuff like the things that Gareth Soloway is saying. You need nobody saying that. You need everybody kind of saying the opposite, actually. You need everybody saying, oh, no, we're not bearish at all. We got nothing but good happening. Because you see, when the last bear turns bullish, that's when the bear market really begins. There's nobody left to buy it. So for this one, even though he's bearish and he's an educated man making very bearish predictions, I'm going to put that as no, it's not a recession indicator. All right. Next up, dollar index. Gareth actually said something very interesting about this right here. So I don't know how he can think that these two things are true at the same time, because he pointed out that the DXY broke a key trend line from 2022. Let's go back to that here. Let's look at that dollar index again. So let's see, if we go back to 2022, and it'll show me this on the 3-year. And it won't show me on the 3-year, so we've got to look at all of it here. All right. So let's see, 22. Yeah, 22. It was at 101 at the beginning, or it was at 9. Where was it? I think he was talking about March 2022. All right. Imagine in March it was at 97 or 98, and we just broke below that. What he's thinking, I don't know how well you can see this. Let me zoom in. He's probably thinking that this line right here, this line right in the middle, is the support line, and we just broke it. Okay, you know what? I tend to agree with that. Yeah, it was 98.69 in March of 2022. That was really where alt season ended, because I remember I was making money in the phantom ecosystem all the way up until March of that year. So I didn't really notice a bear market. I didn't really have much Bitcoin. I didn't notice a bear market till 2022. We broke that support line. Now we are diving under. What if this was a capitulation? Or if this was a major support, now we're going to capitulate all the way back down to where we were here. which would actually be great for us because June 1st, 2021, the dollar index was at 91. We want that dollar index to be in the low 90s because that's going to give us our bull run that we've been waiting for. So could that happen? Possibly. If that support, that was a major support line that has been broken. But here's the real interesting thing that Gareth Soloway said is that he thinks if we drop below 95, that could lead to a capitulation that brings us all the way down to 70. 70 for the dollar index. Now, can you imagine what will happen to crypto if that occurs? Maybe I'll kind of spell it out here for you. When it was down at 91, that was where we got our super bull run of 2021, where Bitcoin went to it already hit its first high of 65,000, but eventually it got to 69,000. So if you weaken the dollar by an additional, what is that, 30%? Yeah, roughly an additional 30%. If you weaken the dollar by that, then you would have much more power being pushed into these crypto prices. And that's where you could see a $25,000 Ethereum. That's where you could see a $1,500 Solana. That's where you could see a $9 $9 EHEX. I don't know what Pulse Chain would do in that. I imagine it would be really good. Sonic would be at $10. And even the GameFi coins that have been beaten down really hard, they would be looking really well as well. Just because of like how poorly the purchasing power of US dollars is if the dollar index went down that low. So I don't know how he thinks the dollar index could capitulate all the way down to 70, but then Bitcoin would be at 75,000 shortly within the next year. Don't know how he thinks those two things can be true at the same time. Because like for a dollar index to capitulate down to 70, I mean that would take at least 1 or 2 years for something like that to occur. It's not a fast thing. The way that this index moves, it doesn't move fast like the volatility index or something. It's not like the VIX. So I'm not sure how he does that. That's why I'd love to get on a stream with him. I don't think I'll ever get the opportunity, though. Soloway does agree with David Bateman's view that the global monetary system is going to face collapse due to unsustainable debt. The de-dollarization that China is doing and Poland is doing because they're buying a whole bunch of gold, he thinks that would push the dollar index down further. So that is an indicator of a recession. I add that to our scoreboard here. We're at possibility of recession. So now it's 11-8. Still a pretty close game here so far. Yeah, monetary system faces collapse due to unsustainable debt. We got $1 trillion being added to the U.S. debt annually in interest all by itself. He sees the potential of there being like a 100-year cycle reset by 2030. That's a long ways away, though. That could be a Great Depression level event. So because it's all the way out to 2030, I'm going to say, well, that doesn't indicate a nearby recession before they turn the money printer on this cycle. Government spending are delaying the inevitable, but a financial reset could lead to social unrest. We do got a lot of social unrest. I'm going to put that as a point over here for yes, recession. Because when it gets dangerous out there, when it gets too dangerous to go outside, because you're going to be shot for your opinion, as we've seen is a real possibility, or if it's likely that you're going to get stabbed on the subway, and the state is going to let your killer go out on the streets without with cashless bail, which they did. That's what happened to Irina's killer. If that's the case, when you got something like that happening, that indicates a recession's coming. Because are you going to go outside? You're going to go outside and do any economic activity when those are real possibilities? No, I sure ain't. I practically never leave the house as it is right now. Now, what are some charts that we should be watching here? We could say, well, S&P 500 is the critical chart. If it breaks below 6,500, there could be a correction then. Could lead to some sell-offs. It's possible there's a 20 to 30% market correction if we get our recession before money printer gets turned on. If that happens, though, bear in mind, like that is kind of going to be what forces the money printer to get turned on. Because you see, remember how I said before, the 50% of consumer spending is done by the top 10% of participants in the economy. If their stocks go down 20 to 30%, that's going to hurt them. You hurt the top 10%, there's no doubt we are in a recession. The only reason that they're not officially calling one right now is because that 10% is sustaining and holding up the entire economy. Danielle D. Martina Booth says, well, the USA is actually in a recession currently, and we've been in one ever since 2022, and it's just been continuing the whole time because we've had so many benchmark revisions to the jobs numbers. And we got negative payrolls in June of 2025, and even though they haven't called like an official recession since the brief one in 2020, you got negative growth quarters in 2022, which they later revised away. But consumer struggles and job losses reflect recessionary conditions that have been felt last year. Obviously, they were felt last year because it's what helped Trump get elected. Yeah. Consumption is 70% of GDP in the United States, and it's not been that great lately. It's not been that great because retail data from Walmart and Target shows that consumers are only buying deeply discounted essentials like groceries, pharmaceuticals, which indicates that there's financial strain, and there's rising delinquencies in student loans, credit cards, and auto loans, which further highlight consumer distress. So that's a point over here for recession. All right. There's also a new law that will allow the government to seize tax refunds from those delinquent student loans, and that will reduce consumers' ability to catch up financially. So I tell you this right here, like on the student loan wage garnishment, because of that, if we get a run between now and May of next year, if we get a good run, I think it all comes to an end then about May, June of next year. Because there, when you see people get some tax refunds garnished, and when it's students, it's young people, the people most likely to buy crypto, there's not going to be a lot of people with a lot of money to buy crypto. Not going to be a lot. So I think that if we get a run before then, it could all come to an end by then. If we haven't gotten a run yet, well, that doesn't really start or end a bull market for us. It just delays it further. So the bull market could get delayed for much longer, maybe a whole nother year in that case. All right. Now, housing market, we got this subprime thing going back on here again. All right, so we already talked earlier about how baby boomers, there's about 77 million of them. They own the oversized homes, but we got declining birth rates, and millennials have smaller families, like they only had one kid if they'd had any at all. That reduces demand for those large properties, and then the foreign buyers are not coming in, they're absent, and the second home sales are at record lows, according to Redfin. So we already talked about that one. That's a point over there for recession. But here's another thing. The subprime crap is back because people that have FHA loans, well, now they're facing foreclosure risks because a lot of those moratoriums that they had back from 2020 during the pandemic, they're coming to an end. Now, Scott Bessent has raised concerns, and that's where they talked about, hey, let's have a national emergency about the housing crisis. Let's reinstate some foreclosure moratoriums because they want to mitigate foreclosures. but it would just be doing what they criticized Biden for doing. You're just echoing Biden-era policies. And that really is just going to make the problem worse. It could really exacerbate it a lot more, and we have a bigger fallout than we had in 2008. So for that one, like that kicks the can further down the road if they get their emergency. So for that one there, what I'm going to say is I'm going to put that in the no category because that could delay a recession by about, it could have delayed it for a whole 18 months. Could delay it for a whole 18 months. Or 2 years, really. All right. I'll talk about the Federal Reserve policy. Modest rate cuts that we're going to have. 25 beeps apiece. That doesn't replicate the zero interest rate policy that we had before. That also doesn't replicate quantitative easing, which really fueled the bull markets of the past. And here's the hard thing to talk about. Like, I think it's important that I give you guys the bad news when we have bad news to report. Like, I'm not going to be one of these guys that fills you all up with hopium all the damn time and never tells you anything that you don't want to hear. This is why you should listen to me, because I will tell you stuff that you don't want to hear. This is one thing you don't want to hear. All of the people that are in line to replace Jerome Powell for a Fed chair, none of them like the idea of money printer. None of them like the idea of zero interest rate policy. None of them like the idea of quantitative easing. They all say that should only ever be used in an emergency. Now, don't get too nihilistic on hearing that, because that doesn't mean that they'll never do quantitative easing or that they'll never dramatically reduce interest rates, because we very well could have an emergency where they got to do it, like a severe market crash, or if the passive investing collapses, that could force the Fed to do things they don't want to do. Passive investing, what I mean by that is when people buy index funds, that's passive investing. A lot of people buy index funds because they believe the Kool-Aid that that's the superior way to invest. But you invest in an index fund when you believe the market is efficient, but because everybody's doing it, it's made the market inefficient. That's why the top 10 stocks are controlling 40% of all the money in the stock market. So if that collapses, if that crashes, that could force them to do QE and the money printer. I'm not betting on that, though. It's not to say that it couldn't happen. It's just I'm not betting on it because I'm preparing for the worst case scenario. So with all that here, I'm going to put a point over here. Because, like, we don't have anything to say that a major disaster like a passive investing collapse is going to occur. We don't have anything to say that a severe market crash is about to occur yet. So that doesn't mean that doesn't really indicate that the top 10% of economic participants who are holding up our economy are going to feel pain, and that causes enough pain to make a recession and have the Fed act to turn on the money printer. There's nothing like that just yet. All right. Now, stocks are overvalued. Yes, we talked about that already. Danielle D. Martino Booth says that's a thing. They're definitely overvalued. A meltdown in the top 10% portfolios could deepen a recession because they control 50% of consumer spending. That would prompt the Fed to take immediate action and drastic action. But without a major crisis, we don't go back to zero interest rate policy. We don't go back to quantitative easing. And the current front runners for a Fed chairman, it conflicts with their philosophies. It's possible, though, that the people that are in the running to be Fed chair, they're saying they don't like quantitative easing, maybe because like they have to. They don't want to give the idea that like they're yes men for Trump and they're going to just print off all this money, print. They don't want to give that idea off because you don't want another Janet Yellen in there. You don't want another Ben Bernanke in there because history is not going to look very favorable on those two people. Now, when we talk about inflation, Some people they don't go with CPI, they go with a website called Trueflation, which I'll show it to you here. It's a lot more lenient on what they say inflation is. Let's see, Trueflation. Basically, it says that the inflation rate is a lot lower than what they're reporting. And CPI, they say it's just 2.12%. I don't know if it's true. I mean, I don't know how they measure it in comparison to CPI. I don't know how they do that. I mean, obviously they index things differently. They give everything a little bit of weight. But according to this here, we don't have real bad inflation. We're actually going to have some deflation. That's what they think. Grocery prices, they remain high, but rents are going to be coming down, and home prices are going to be declining because nobody's buying the homes. And consumers are focusing on discounted essentials, which reflect weak purchasing power. So even if you put tariffs on all the goods out there, you don't really have the ability to raise the prices because the consumers don't have the ability to pay those prices. So, going back to our scoreboard, I'm going to say this is a point for no recession. So it's 13-12. Very close race here. Very close race. You see, this is why September is sucking so far for crypto. Is just look at how we're breaking down this stuff right here, and we see how close it is. If it could go either way, where it could be really good or it could be really bad. That's economic uncertainty. We get a little clarity on the uncertainty this month with all of the reports coming out, with the Fed decision, also with are they going to pass a budget by September 30th? Because there's a looming government shutdown possibility if they don't pass a budget by September 30th. This is why September sucks. It's because you got this much economic uncertainty and you're seeing it live on display right here. Another thing that is too close to call here is the fiscal dominance claims that Lynn Alden says, because the United States still retains its reserve currency status, and there's still strong demand for treasuries at the treasury auctions. They don't really have trouble selling them. You see, a big problem. This would be the worst thing that we could possibly experience. It's not the United States being unable to pay back the money it borrows, but the United States being unable to borrow more money. That's the real big problem. So it's not the Treasury defaulting on its debt that we should ever worry about, but the Treasury not having ability to take on new debt. That's a huge problem for the United States, because then they're going to have the massive austerity come in that would turn GDP to negative 10%. So we got $1 trillion in annual interest expenses in our treasuries. That would indicate that, well, maybe there's not enough demand for it, which, yeah, kind of, that's true, but it's not the whole truth. Because when you look at the alternatives, sovereign bonds from Europe, from China, from Japan, well, they face a lot worse debts and inflation issues. So while the debt situation here in the United States sucks, it sucks the least in the entire world. We're the prettiest fat chick at a party full of fat, disgusting pigs. So that makes the U.S. It's not ideal. It's not crappy. It's more ideal than everybody else. See, fiscal dominance. That's going to require a collapse in borrowing capacity, which meaning we try to borrow more money, but they don't let us. Compare that to France, as France has got some very terrible fiscal challenges. They got high youth unemployment, they got political instability, there's bailout concerns, and the larger economy that they have and banking footprint, it poses contagion risks all around the world. But the EU could stabilize France in isolation because it did it with Italy previously. So a broader crisis like a U.S. recession or UK instability or European banking dominoes, that could threaten the euro, which would be as bad as the Lehman Brothers collapse, but think of it as like Lehman squared. That's how big the problem would be. It'd be exponentially worse. So, because fiscal dominance is not necessarily a big thing yet, I'm going to put a point over here for no recession. And ultimately, like no money printer for a while. What else can we look at? Okay, well, we could look at the ISM manufacturing PMI. That's producers manufacturing index, or producers material index, actually, is what that is. Right now, that's at 48, which is below the 50 threshold. It's at 48.7. If it was above 50, that would indicate no recession. Since it's below 50, that indicates that there could be a recession. Now we got a point over here for recession. Very exciting game, isn't it? We're so close. It's neck and neck. And historically, like the business cycle peaks have it at between 60 and 65, which would be indicating a strong expansion before a downturn. So the current low reading suggests the economy is far from a peak. It's got a lot of room for growth and a lot of potential for a pop, like an overinflated balloon. The Michigan Consumer Sentiment Index is at 58, which is down from where it was at before. It was at 61, but its long-term average is 85. And previous market crashes, they saw sentiment at 83 or higher, because that reflects euphoria. So today's sentiment is cautious at 58, and that aligns with like some early to mid-cycle conditions. That says, no, not near a recession or a crash or anything. No need for money printer yet. And it also kind of supports the idea of, hey, when other people are fearful, that's when you should buy. So basically, it's telling us we should buy in that case. Let's see, we already went over housing market. Oh, there's another index with housing market. That's a National Association of Home Builders or a housing market index from Wells Fargo. It's at 32. Prior to the pandemic, it was at 76. So it indicates pessimism among builders. That is a recession indicator. Very close game so far. The job quits rate. Another thing we look at is the quit rate for when people quit their job. Right now it's quite stable at 2%, which is near the long-term average of 2%. When the quits rate is high, like 3%, as it was in November of 2021, which coincides with the peak of the crypto market, or the Bitcoin bull run, that signals worker confidence and an overheated economy. Today's cautious rate indicates that workers are clinging to their jobs and they're consistent. They're clinging to their jobs and they don't want to lose them because they think it'd be harder to go get another one. So that's consistent with the early to mid-cycle dynamics. So I'm going to put that over here for no, not a recession. Even though it kind of feels like one. Over 82% of central banks have recently cut rates. Switzerland is actually at 0%. They're doing ZERP. Japan is close. They're at 0.5%. The Eurozone is at 2.15%, which the one with really the highest rate right now is going to be U.S. federal funds rate at 4.5%. We get a rate cut coming up in 2 days, though. So there's still a lot of cheap money that can come into the system and fuel the speculative assets like crypto, and also fuel a lot more market growth. So that would say, no, not a recession coming. All right. Cryptocurrency market outlook. Well, even though Bitcoin's been in an uptrend since 2023, it stayed above 100,000 for 11 weeks. So that kind of makes it look like a very powerful support. That kind of dismisses a lot of September's bearish seasonality. And, well, we might have a very volatile September and a very volatile 2025, or a very volatile quarter four. I think that what's going on in crypto right now, just with how oversold that those altcoins are, it just doesn't indicate that a recession is coming. Or at least a massive drawdown in crypto. It doesn't look like that's coming. And even when you got like high profile events like Donald Trump launching meme coin and a DeFi protocol, it's just kind of being dismissed as noise. It's not really treating the market, or it's not being looked at as a market cycle top. Those events, they would mimic past speculative excesses, but they're not really kind of indicating a cycle top this time around, or people aren't thinking that they are. So I'd say, well, we're not at the end of the line here just yet. So I'm going to put in our point right here for no recession. The final score, 17-15. Looks like there's not a recession coming. All right. Which is good, because you see, that would mean it would get really ugly first before it got good again. And I think that ugliness coming in would throw a lot of people off. It would get a lot of people to think that it's all over. And because people think it's all over, a lot of them will sell out and not come back until it's much later and much too late for them. So I think it's good that we don't have a recession, even though a recession would kick the money printer on for sure. I think that there's still a lot of other ways in which they can get the money printer going again here, even without a recession or a disaster. And by money printer, I don't necessarily mean quantitative easing. I think we can still get it from other things here, and I'll explain that in a moment. But first, may play a little public service announcement for you guys. You're listening to a Reinvent Ideal live stream. The phrase reinvent ideal isn't just clever wordplay. It's a manifesto. For decades, society handed us a dusty old blueprint for life. Work 9 to 5, climb a corporate ladder, buy a house you can't afford, marry young, pump out kids, spend 40 years in a hamster wheel, and if you're lucky, retire at 65 with a gold watch and arthritis. That's the ideal we inherited, but it's a lie. A boomer-delivered illusion that made sense in 1970. But in today's world, it's a recipe for debt, burnout, and disappointment. Reinvent Ideal is the antidote. It's about rejecting the outdated script and designing a new one. A life where freedom, autonomy, and leverage replace status chasing and financial enslavement. Where your ideal isn't dictated by suburbia and social media, but what keeps you sane, sovereign, and alive. Instead of status symbols, we pursue rare and in-demand skills that buy independence. Instead of debt-fueled materialism, we choose minimalism, shedding liabilities and obligations. Instead of working to death, we embrace crypto and investments that multiply freedom instead of shrinking it. The new ideal isn't about fitting into someone else's mold. It's about building a life that maximizes your time, choices, and sovereignty. Reinvent Ideal is about giving yourself permission to redraw the map. All right, so where does that put us? Where does that put how we're going to navigate the crypto market here? So, got a couple of other things I can show you that I think will tell us why, or what's going to happen and why. Let's start with like the Gareth Soloway thing right here and the stuff that he says. So this was him on the Michelle McCory thing, called The Real Story of Michelle McCory. This is what he had to say.
So I do think, I can't tell you where it's going to be in 10, 15 years from now, but after a correction that I do think we are close to, and I will go on record and say I do think Bitcoin's going back to at least $75,000 a coin, probably by early 2026. But I do think at some point it goes a lot higher, and then we'll just have to see how the whole, world-ending type scenario comes into play with it.
Now, for this prediction, what he's saying is that he thinks it corrects first, and then later it goes higher. And I think what he means by that is like the very next bull cycle, because he's one of these guys that thinks we're already in one and it's almost over.
But I do think that, again, society is craving an alternative to fiat currencies, and Bitcoin is that answer for now, along with gold. And people are willing to accept it. And as long as people accept it and can access it freely, then that still has a place in the future.
That's a pretty big statement.
So with this one here, I don't know how he thinks like the two things can be true at the same time. Because like what he's saying is that, yeah, it's definitely better than dollar bills, and dollar bills is going to take a beating when that DXY goes down. But he's also saying, well, then Bitcoin is going to correct. Well, if you're weakening the thing that Bitcoin is priced in, how does Bitcoin's price not go up? So I wish that like Michelle here was. I wish she would question him like I would, but not everybody can be like Cairo.
You see Bitcoin pulling back to $75,000 by 2026.
Yeah, and probably I would say within the first quarter of 2026, even cutting myself even lower here.
You wouldn't see a massive rally on the rate cuts, more liquidity, or then as the market starts to sell off, I guess the correlation has always been there. Is that what you would see happening with Bitcoin?
That's more what I see is the correlation, right? So if we look at 2021, when we had the bear market in the stock market, we obviously saw Bitcoin falling all the way below 20,000. I don't think it's going to fall as much because you have a much more.
All right, so that's true. There is like a lot of correlation between the stock market and Bitcoin. And we had a lot of correlation in the last run that we had, in the last bull market that we had. But I think that there's still a lot more juice left in the stock market, not that we depend on it or anything. And there's definitely a lot more juice left in crypto here. So I wish that she had questioned him a little bit harder on this.
Diversified group of holders, including big players like BlackRock. But I do think, you're talking if the stock market corrects 20 or 30%, Bitcoin likely corrects 30 to 50% from these levels.
And what would cause that would be forced selling and also forced selling is what would be causing that, just forced selling itself. When you look at some of those allocation funds, if the stock market had gone down, well, their charter is telling them they got to sell some other assets to buy back into the stock market and push their allocation into it up. A few other things here that stood out to me. This one right here. Chinese investment heads for one of the worst years on record. They're experiencing an economic slowdown. So here's the deal. It doesn't really have to be us here in the United States that has the recession. Another superpower can have it, and China is already doing their money printer to try to fight this here. They're already trying to fight this with their money printer. So this could be what exists in place of quantitative easing over here in the United States. Here's another thing here. Like, they will have to cut rates, and they will have to cut them a lot more than they're prepared to cut them this Wednesday because of this here is the banks that have so many unrealized losses on their investments. Because you see, banks are tightly regulated, and they got to invest largely in bonds and fixed income investments, which is just another way of saying bonds. Well, when you invest in bonds, when you got a bond and interest rates go up like they did in 2022, your bond prices will go down, and that gives you an unrealized loss. All right. You get an unrealized loss there because you haven't sold your bond yet. When you sell it, you realize it. And that's basically looking at, it's like looking at red numbers in your MetaMask when you got a unrealized loss. So because they're sitting on this, the only thing that fixes this is either one, they keep holding the bonds all the way to maturity, which they're probably going to do anyway. But that puts them in a very precarious position because what if people decide to have a run on the bank and they want to take some money out, or it doesn't even have to be a run on the bank. People just want to get their money out of the bank. If they do that, well, they're at these unrealized losses. They're going to have to realize those losses. That will drain the bank faster of capital than they are prepared for. So they have to cut the interest rates to kind of save these banks here because when they cut interest rates, that will take those unrealized losses and start minimizing them and possibly even reverse them. So they're going to have to be a lot more cutting than what they're prepared to do here. Like all this blue, that's held to maturity securities. That just means bonds. They got to hold them for a certain. They got to hold them for a long period of time to get all their money back guaranteed. And then the brown here, the sort of crap brown shade, is available for sale securities. That would be things like stocks or T-bills, short-term bonds that they can easily liquidate right now and not take so much of a haircut on. But even with those, they got some losses, some unrealized losses that they're sitting on there with it. So it's still looking pretty dire for those banks. They do got to cut those interest rates in order to save those banks. Now, when you cut interest rates, while that's not as effective as the Fed doing the money printing, that allows banks to do more money printing on their own because now they can lend at a lower prime rate. We like that. So I think that might be another catalyst here in getting the bull market really going. I think that could be a catalyst coming up in the next couple of months. So while September is going to suck, be prepared for September to suck. We could have a good October. We could have a good November. And who knows how long it can last? Who knows how long it can last here? I mean, if we have a recession come first, it's going to delay the bull market a lot further out. But if we don't have it come, if like the scoreboard that we did today here is true, well, in that case, a lot of this could wrap up quicker, like in the next 6 months here or so. So that's what I got here for right now. Let's take a look at some questions. Anybody submit some questions here? Johnny had a comment earlier. He says, "I say that the money printing is soon. I had 3 banks call to ask me if I'd like to borrow any money and want me to sit down with them in-house to hear their pitches." Okay, well, that's good that you're hearing that, because you see what that tells us. What that tells us there is that the banks have already made their assumptions about Fed interest rate policy, and because they've already made their assumptions about Fed interest rate policy, what they're going to do is just go ahead and front run the Fed and be offering lower rates for borrowing money right now. Let's see, when the banks are cold calling, something is up. That's right. Let's see, anybody else have any questions here? Don't really see any others right here. Oh, Ash had a comment here. Let's put this up. Here's the missing dynamic people may miss. The tariffs may have to come off due to Supreme Court ruling overpowers Trump. Oh, yes. That's a big deal if that happens there. If the tariffs get reversed, I mean, not only will they not be collecting any new money and reducing the deficit, but also they have to refund all the money that they've collected so far. Now, here's the interesting thing. Despite all this money that they are bragging about collecting from tariffs, the federal deficit is still expanding, still getting worse. And if they have to refund all those tariffs, that federal deficit is going to be way, way worse. And I think then they're going to have to do some more interest rate cuts drastically, or they may have to turn on the United States money printer. That's something that could, maybe it'll be negative at first. You'll see like some corrections in the market and some pretty nasty ones. Like usually Bitcoin go all the way down to 100,000 flat, maybe even a little bit lower. And Ethereum might go back down into the 3,000 range. But once they turn that money printer back on, that reverses, and then we can have our real bull run get going. We can have our real bull run get going there. Toblerus, you say you got a question from an older video? Go ahead and ask it here. Get it in quickly, because we're kind of running down to the end of this stream here. We're waiting for you. In the meantime, I also share with this for you guys here again. If you haven't already subscribed to my Substack, you want to go ahead and subscribe to it. It's reinventideal.substack.com. And once you're there, come right here into the middle and click where it says free gift. Because when you subscribe, and it's 100% free to subscribe, you get a free copy of my book, Your Parents Were Wrong. That's right. You'll get this book 100% free. Costs you absolutely nothing to subscribe to my Substack. All the articles I've written on there are 100% free. One of these days, I will have paid articles, and if you want to get ahead of it and go ahead and be a paid subscriber right now, you will get a copy of this book. It's called Bitcoin Begins, which is Bitcoin Explained Using Batman. You will get both books for free if you become a paid subscriber. And that is my Substack. That's reinventideal.substack.com. All right, we got Todd LaRusse's question in here. He says, you said Bitcoin will eventually have a bigger than 21 million supply because soon people will invest in Bitcoin via stock holdings of companies with BTC in their treasury. Is that bad for Bitcoin price or with more supply? Well, let me clean that up a little bit here. That won't increase Bitcoin's official supply. It will still be at the 21 million. But the 21 million limit is going to be less relevant to the pricing of Bitcoin just for the fact that anybody can invest in a treasury company and a treasury company can issue as many shares as they want. And there's no limit now. It's not a scarcity thing anymore where they say like, well, Bitcoin is scarce because there's only 21 million. Not everybody on Earth can have it. And that's true. But here's the thing is like if I can have a full share of a treasury company or a company that has Bitcoin in its treasury, I'm not concerned about having a full Bitcoin anymore because, hey, I got shares of a company that has several hundred Bitcoin in its treasury. So now that talking point that the Bitcoin maxis like Max Kaiser jerk off to all day long, that talking point is gone. That doesn't mean that Bitcoin is going to die. That doesn't mean that it's going to make the price go down. I mean, it could affect the price, yes. It just means that talking point that they use as hopium for the price is now gone. Everybody that wants to own a piece of the Bitcoin is going to be able to and own a lot of it if they can get to own shares in a company that has on its treasury. And I think that all these companies that are going to be having Bitcoin in its treasury or any crypto asset in general, I think that all of that is good for the crypto ecosystem all on its own. I think it's good for all of crypto when you got these TradFi companies adding it to its balance sheet. All right, guys. That's all I got for today. Be releasing a new Substack at some point this week and probably be doing a stream about the Federal Reserve's meeting and press conference if anything eventful happens for it. So until then, we'll see you next time, guys.
That is it for us today, you glorious degens. Smash that subscribe button to join the rebellion and follow me on X at ReinventIdeal for more unfiltered truth bombs between live streams. And if this was your first time listening, head over to reinventideal.substack.com because I have a free gift waiting for you there. If you become a free subscriber, you'll get a free copy of my book, Your Parents Were Wrong, Debunking and Replacing Outdated Advice, packed with the wisdom to outsmart the system. It's absolutely free to join, so no excuses. Grab it before the suits catch on. And remember, the bears get blocked right here and told to shut the FUD up. Until next time, this is Cairo Copeland, your millennial Moses,